Hello, friends. As always, it's a pleasure to again connect on this edition of Tarakki Talks. We are going to be discussing on the ICICI Prudential Flexicap new fund offer, which has begun today on 28th of June and will close on 12th of July. But first, as always, let's hear on what's happening in the globe, what's happening in India, and then probably we'll speak a bit on the NFO itself. Clearly, the last 1.5 years has taught us that importance of asset allocation and how you should be rightly invested in the right places in equities. Because if you go back in March 2020, hardly any one of us would have expected the markets to be where they are today. But they are there where they are because the central banks brought out a lot of liquidity, a lot of money was printed by the central banks starting from March 2020. So while this pandemic is unfortunate and of course we are still reeling with it after 15 to 16 months of it first breaking out, we still believe that the ability of the central banks and the central governments in terms of how they have handled the situation has meant that the economic impact of the pandemic has not been felt as much. Yes, people have lost jobs. Yes, it has been a struggle for a large part, and that's where the governments are coming in and helping those who have got hurt. But if you look at the larger part, because of all the liquidity infusion, what has happened is the metal prices have gone up: aluminium, zinc, copper, steel. The agri commodity prices, soybean, corn, cotton, sugar, they have also gone up. And in general, along with the improvement in demand because of the money which has gone into the people's hand, people are consuming more. There is an upliftment in economic activity across the board. That upliftment in economic activity across the board is also reflected in the equity markets globally, where almost all equity markets, all countries are at their lifetime highs or all-time highs. Now, if you look at India, clearly India stands out in the globe. We have seen in the last 12 months or so, foreign institutional investors investing in India in a big way. The largest ever investment in the 12-month period in India has happened in the last 12 months. And it is not surprising. Let us see the reason why. If we look at the world today, there is a lot of money which has been printed in the last 12 years, more so in the last 1 year. And many of the sovereign bonds are yielding negative interest rates. So the interest rates, which in India, for example, are around the 6% mark, they are negative in many countries if you keep in the government bonds. So much liquidity in the globe. So wherever a foreign investor or a pension fund finds opportunity for growth, they will want to invest in that particular country. And India stands out today. We have a $600 billion reserve, which is making our currency much more stronger, much more stable. We have, in terms of growth, expectation of upwards of 8% GDP growth for the next 2 years. And if we see from that perspective, many of the sectors in India are expected to do well. We already saw the information technology, which is the IT sector, and the healthcare sector get the benefit in the last 12 to 15 months because of whatever is happening around us. The healthcare has caused an investment in the health sector, which is helping our Indian health companies or pharma companies and healthcare companies. And the IT companies, because of the lockdown and the work from home, the expenditure or the budgets for information technology have also improved. So IT and healthcare already have done well in the last 12 months. If you look at the future, telecom, power, banking system, automobiles, they all seem to have a much better future because of the increased money in the hands of people. And clearly, in terms of the growth, we've seen India coming out of an earnings degrowth cycle or an earnings weak earnings cycle. Last 5 years, the corporate profitability in India was very weak. In fact, if we see the corporate profit as a percentage of GDP has come down from 8% to 2% in the last 12 years or so, and is on its way up. So not just our economy will grow from $3 trillion today to $5 trillion, but it will also mean that when the economy grows, the profit to GDP may also bounce back. So there will be probably a twin benefit to our corporates in terms of the share of GDP profit, which is going up, plus the GDP itself going up. And hence, at a time when interest rates are low and investment avenues are not easy to find, equities should become an asset class which will probably fit in your overall asset allocation. Now the question comes, is this the right time to invest in equity? And if so, how do we invest in equity? And that's where the ICICI Prudential Flexicap NFO, which we have brought in, comes into the picture. With the Flexicap NFO, essentially, what is a Flexicap fund? By definition, a Flexicap fund is an unconstrained fund which can invest in large cap, mid cap, small cap across all sectors. And hence, from a fund perspective, it gives the fund manager the leeway, the flexibility to invest in large cap, mid cap, small cap in the proportion that they like in the right stocks and sectors. So that's an unconstrained mandate. That's the first part. What we are doing in this fund, and we're trying to bring in, is the fact that investing in large cap, mid cap, small cap in a objective manner through a model is something which we are bringing in this fund. And it is something where we believe that if we have a simple model and it is applied with discipline, it will help your investments in the long run. So the market cap model, as we call it, is a very simple model which defines how much large cap, mid cap, small cap should be there in the Flexicap fund. And it is seen that typically when mid cap, small caps do very well, it is time to take money off them and probably reduce the exposure. At the same time, if mid cap, small caps do very badly as they were in 2018, 19, 20, they provide good opportunities. And if you can increase your investments at that time in the mid cap, small cap space, it will help your investments in the long run. Now, what happens is typically as an investor, because we are pro-cyclical, we invest in mid cap, small caps when the markets are high, while we take it out from the mid cap, small caps when the markets are low, which does not help our long-term wealth creation. And hence, the model-based approach in the Flexicap fund, wherein we will decide the large cap, mid cap, small cap based on an objective manner and apply it with discipline, we believe will help in the long run. The model itself is based on valuation differentials between large cap, mid cap, small cap, and how much of the overall market cap is represented by large cap, mid cap, small cap. So it's a very simple model, but when applied with discipline, we believe it will help this fund and in turn help your investments to get a better risk-adjusted return. Now, the second aspect of the question which comes to everyone's mind is, how do I invest today when it is all-time high? Should I invest in one go, or should I invest in a manner which my funds get deployed over the next 3 to 6 months? That's exactly what we are going to do in the Flexicap fund. We will probably look to invest in a staggered manner over a period of time, and in turn try to get an entry point in the right stocks at the right price. Now, the fact remains that markets are not predictable, and hence the fund manager will try to curate a portfolio which will ultimately help your long-term objectives of wealth creation over the next 3 to 5 years. Equities as an asset class have possibly many reasons why they are volatile, and hence a Flexicap fund, if it is managing the large, mid and small cap in a manner which we are doing with a model-based fund, and also the fund's stock picking. Now, if the fund manager, the way we are going to curate the portfolio is that we will try and keep it less concentrated and diversified across sectors. That also helps control the risk of the fund and have a better risk-adjusted return. So, in a nutshell, India has enough opportunities across many sectors and stocks. If I look at the kind of opportunities that are there, and when we are going to move from $3 trillion to $5 trillion, another question which comes, especially when people are looking to invest incremental money in equities today, is that we are at all-time highs. Is this the right time? Is this the peak of the market, more importantly? The simple question or the simple answer is that 12 years back when we hit the previous peak, we were $1 trillion in our GDP roughly, and the markets did hit a peak of $1.5 trillion. Then it had a fall. Then again, in the last 12 years, the GDP has grown from $1 trillion to $3 trillion. And our market cap also today is roughly around the $3 trillion mark. So if we see, there is a correlation between the GDP and the market capitalization, and in fact, the market's barometers as well. As the GDP grows, which it does nominally, and since India is also a growth economy, it will show a growth from 3 trillion to 5 trillion over the next few years. When the GDP grows, it is nothing but a sum total of economic activity of all the listed and unlisted players put together, right? Government spending, capex, export minus import, all of it put together is what forms the GDP. And if we basically look at the way we are structured right now, the 3 trillion to 5 trillion move in the GDP, if it is accompanied by a 3 trillion to 5 trillion dollar move in the market cap, there is a $2 trillion market cap, which is basically waiting to be created. Now, $2 trillion is roughly 150 lakh crores Indian rupees, roughly. So that's the amount of wealth which can get created, which would also involve new companies getting listed across many sectors. We're already seeing in the last 3-4 years, many new sectors getting representation in the markets. Life insurance sector is one sector which comes to our mind. So the opportunities in India for investment are widening, and with the corporatization culture improving, and with all the changes that have happened in the last 5-7 years in terms of regulation, that is ultimately going to help the equity markets for the next 3 to 5 years. Indians by design in the past have had a low allocation to equities. We've had only allocation to equities less than 6 to 7%, I think, of our overall allocation, while in US it is about 35 to 40% of the savings. So there is a gap, and that gap needs to be filled by us, and that's where we felt that at this time it is opportune to bring the NFO of Flexicap. It is a new category which was created, I think, 8 or 9 months back, and it is an unconstrained category. So from a timing perspective, from the way the portfolio is structured, and more importantly, we're bringing in probably for the first time a model-based approach to large, mid, and small cap allocation. If applied with discipline over a 3-year, 5-year, 7-year, 10-year period, we truly believe that this will add a lot of value to the investors, and those investors who are looking to invest in fully invested fund within equities, they should have a look at the ICICI Prudential Flexicap fund because one, from a timing perspective, if you give us the money today in the fund is going to stagger the investment. So there's no immediate big investment which will happen. Will be invested in a certain proportion, and then next over the few months, maybe next 2 to 4 months, the investments will get staggered. So it will be a fund manager call as to when to invest and where to invest and how to invest, with keeping in mind the view that next 3 to 5 years, if they are buoyant in the equity markets, it will be helpful. Now, one more thing which comes to our mind is that why am I saying you should invest to the Flexicap fund at a time when people seem to be making more and more money out of direct equity stock investing, which looks easy when the markets are good. In the last 1 year, there has been a widespread rally in the markets, and investing in stocks, which otherwise requires a lot of research, a lot of patience as well, and a lot of thought process, without basically, in the last 1 year, there's been significant rally in many stocks, and it hasn't required probably a lot of research, because the valuation starting point in March 2020 were very low across many stocks and sectors. Now, obviously, that's not the case, and it is going to be more stock specific. So over the course of next maybe 5 to 8 quarters, through the results which will come in, it will basically showcase which stocks are going to do well, or which sectors are going to do well within that, which stocks are reporting better numbers, have a good management and better balance sheet quality, as well as better opportunities for growth in the next 3 to 5 years, and they may do better than the rest of the market. Also, the risks in some of the stocks which have gone up too much are high, and that probably is not something which you as an investor may be able to factor in without the necessary risks and checks and balances, which otherwise a professional investment manager or a fund manager would do. So just a word of caution that last 1 year was probably easy in terms of making money in the markets. Next 2 to 3 years may not be so easy, and hence investing through the Flexicap fund, where not only will you get the right balance of large cap, mid cap, small cap based on our model, market cap model, and the staggered investment, you'll also have a diversified portfolio which will be spread across sectors. For example, if banking is the largest sector in India today in terms of its representation in most benchmark indices, you will find the right stocks from the banking sector based on our assessment for the next 3 to 5 years being part of the portfolio. At the same time, we are cognizant of the fact that we should not have too large a concentration in a single stock if it's a mid cap, small cap. So that also will be taken care of. We will not take very high concentration into a single mid cap and small cap unless we have a very high conviction. So it's a diversified portfolio which also reduces your risk from an overall portfolio standpoint. And if there are stocks which probably in terms of valuation don't fit in, or do not have the necessary growth potential, yet they have done very well in the past. It's best not to have them in the portfolio. So it's something which would be difficult for you who does not probably follow the markets day to day to assess. But as a fund manager, as an entire analyst team, it is a day-to-day job to figure out which stocks which stocks have a better chance of falling into the category of good businesses, good managements with good growth prospects and sound business principles, and curate the portfolio in a well-balanced manner. Despite putting all the due diligences and everything, also because the markets are so dynamic, stocks get affected with so many factors. There is a chance that 2 or 3 of the picks that we have out of the 35-40 stocks that are there may not do so well for us. But as an overall basket, the idea is, as an overall portfolio level, the risk-adjusted returns which you as an investor should get should be good. Like I said, the NFO closes on 12th of July. We believe that those investors who are waiting at the fence, who probably have the money but have been waiting for a meaningful correction and have not got a meaningful correction for the last 15 months, they may look at this portfolio, they may look at this as an investment for the next 3 to 5 years in the fully invested category, should their asset allocation allow. And we believe that because this fund, which is the ICICI Prudential Flexicap fund, has an unconstrained mandate, it allows the flexibility to the fund manager, and in turn creates the opportunity for a long-term wealth creation for the investor. It's a blend which probably is very good, and hence we like this fund a lot as an investment avenue for you. No doubt that March 2020 was a better time to invest than today, but the fact remains that markets do not always give us the opportunity which they did in March 2020. Such opportunities are occasional. We can't wait for those opportunities always. And as it is said, time in the market is more important than timing the market. Many people think that they can time the market in terms of they'll buy when it is low, they'll sell when it is high. It does not work that easily. Dynamic asset allocation funds are specifically meant to do that. So while you will find it difficult to do it yourself, you can possibly look at the Balance Advantage Fund category for your investments as a core when you are looking to buy low, sell high. And for fully invested funds, we truly believe that the Flexicap funds, which have a wider mandate, will suit your overall requirements well. Again, as a word of caution, be careful about rear view mirror based investing. In other words, don't look at the past returns and invest. Don't go by the past high returns of a particular sector or a particular stock and invest in that. While it may do well for you, and I hope it does, it also is fraught with risk. So especially I have seen that many investors are looking at international investing in a big way. And I believe that international investing has its own merit, but you should do your own due diligence before investing there in a big way, because some of the sectoral funds there have done pretty well. And if you're entering them right now, it may be something which can probably hurt you if the tide turns over there. So be careful or cautious on that. While in India, like I said, things in terms of many sectors are looking very bright. If we look at, like I was mentioning earlier, we are the second largest steel market, or the second largest steel consumer. We are fourth or fifth largest automaker and auto consumer. Courtesy our middle class, which is expected to go to 50 crore individuals by 2030. The entire consumption basket can potentially do well. And given the healthcare pandemic and the fact that IT sector is doing well, IT plus healthcare, which also is a large representation in India, they are also expected to do well. So in the last 8 to 10 years, because of the metals and the energy prices being low, and the fact that real estate was going through a downturn, Indian corporate earnings weren't that strong. For the next 3 years, because the real estate cycle is probably turning, if you look at it, since IT sector is doing well, cities like Bangalore, Delhi, Gurgaon, Pune, Hyderabad, they are basically seeing reasonably good demand from a real estate perspective, and the listed players at least are reporting reasonably good numbers, which augurs well for the real estate sector. And the metal sector, which was in trouble, and many of the NPAs were in that sector, that is also reviving. So from a banking system perspective, also things are looking good, and banking is the largest weight in most benchmark indices. So The all-time high and the fear of investing in peak is something which is always going to be there. And it's not like markets will not be volatile. Over the next course of 3 years, you will find that this liquidity printing will have to stop or will have to come down. And eventually interest rates globally will also go up, which typically hurts equity markets. Also, since global equity, especially the US equities, are at an all-time high in terms of their market cap to GDP, it is something which also can cause a potential risk in terms of the volatility in the market. So markets are going to be volatile. You need experts to basically handle your money in terms of which stocks, which sectors the money should go, and where the large cap, mid cap, small cap, how much should be the proportion. And clearly over the next 3 to 6 months, if the staggered investment approach is basically utilized, it will do well for your investments because waiting on the sidelines, while it can be handy if there is an immediate market correction, at times we've seen that people wait, and then finally capitulate at the wrong time when the markets are at their peak, the business cycle is at their peak. So just to summarize the entire discussion, we are strong followers of the VCTS framework, which is essentially valuations, business cycle, triggers, and sentiment. And today, if I have to just summarize the valuations, they are probably looking stretched, but the earnings growth potential in the next 2 to 3 years can potentially justify a slightly higher PE today. The business cycle, we are just starting off from a trough in terms of business activity. From a negative GDP growth caused by the pandemic, we are seeing a higher GDP growth. Credit growth hopefully will expand. Capex will also hopefully expand. And from a perspective of business cycle, we are expecting earnings also to improve with the broadening of the market in terms of the activity, in terms of the economic activity. In terms of triggers, there are no negative triggers right now. I don't immediately see a risk of oil prices hurting the economy while they will remain strong, or they may remain strong and they may reach 75, 80, 85. It is unlikely that they will impact India negatively immediately. So at least for the next 12 to 18 months, it's not a red signal. And if you look at US interest rates, US continues to print money. So at least till 2023, that risk seems to be behind us. So immediately, I don't see the next 12 months negative triggers, while probably the volatility and the way the markets have moved in the last 1 year on a one-way direction, that may not remain in the next 1 year. We will see volatility. But at least immediately, I don't see any major triggers for a sharp market downturn. And the last part, which is sentiment, clearly today also, if we see people are cautious, I think people are waiting to invest in the markets. They are not jumping in. There is not much euphoria. In mid and small cap, there is a lot of activity which is happening, no doubt, and investors are investing in that in a big way. But from a market standpoint perspective, it is not so euphoric that we need to worry. So the sentiment, like it is said, is cautiously optimistic, and that basically also means that on our VCTS framework, we believe that at least for the next 12 to 18 months, there may be some opportunities which the investors should make use of, and there are enough good stocks in India, enough sectors in India, where through participation in the equity markets, you will benefit. And most importantly, because inflation is coming back, if you allow inflation to eat away your returns by being heavily invested and tilted towards fixed income, it can potentially be an impediment into your wealth creation. So it is said that inflation eats away your growth if basically inflation is running higher than your fixed income, and hence if the expectation is a higher inflationary environment in the next 2 to 3 years, it is probably advisable, and you can basically reach out to your advisor and get some sense as to how much equity you should be in and whether you need to increase your equity. And if the equity allocation allows you to increase equity, the Flexicap NFO is something which we would probably recommend you should look at and have in your portfolio as a core holding for the long term. Given that the Flexicap funds are unconstrained, they can invest in large, mid, and small across the board. And from the way we'll manage it, from a stock selection perspective, also the 3 to 5 year business growth with management quality being strong, and also the fact that it will be a well spread in terms of sectors and no concentration of stocks. The endeavor of having better risk-adjusted returns for the investors would hopefully get achieved. Thank you so much, as always, for listening, and I look forward to seeing all of you in the next round of Tarakki Talks. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.